You found the car. You negotiated the price. You sat in the finance office, and the man across the desk pulled up your loan options. He typed something. He turned the screen. He said, "Based on your credit, this is the rate we can get you." You looked at it. It seemed about right for the market. Maybe a little high, but not outrageous. So you signed. You drove home. You felt good. You bought a car. You were overcharged, not on the car, on the loan. And the person who overcharged you was sitting across that desk, looking at a rate you were never shown, a rate lower than the one he offered you, and pocketing the difference, legally, silently, with your signature at the bottom of the page. It's called dealer reserve, and it is one of the most common, most profitable, and least understood financial practices in America. Here is how it works. When you finance a car through a dealership, the dealer submits your credit application to a lender, a bank, a credit union, a captive finance company. The lender evaluates your credit and responds with what's called the buy rate. That is the actual interest rate you qualified for, the lowest rate the lender is willing to accept for your loan. The dealer sees that rate. You don't. The dealer is then legally permitted to offer you a higher rate and keep the difference as profit. If the lender approves you at 5%, the dealer can quote you 7. If the lender says 4, the dealer can say 6. The gap, 1, 2, sometimes 3 full percentage points, goes directly to the dealership as compensation, not as a disclosed fee, not as a line item on your contract, as invisible margin built into the rate itself. You signed a loan at 7% and felt like that was the market. The market said 5. The 2% difference was the dealer's cut, and nobody was required to tell you. Now, 2 percentage points might not sound like a lot. It sounds like a rounding difference, something you'd barely notice on a monthly payment. Let me show you what it actually costs. On a $30,000 car loan over 60 months, the difference between 5% and 7% is approximately $1,600 in additional interest. Not across your lifetime, on one car, one purchase, one afternoon in a finance office. And the average American buys a car every 6 to 8 years. Run that over a lifetime of car ownership, and you are looking at thousands, potentially tens of thousands, in markup you were never told existed. And here is what makes this worse than a high price. You negotiated the price. You spent an hour going back and forth. You felt like you won something. And then you walked into the finance office, tired, relieved, ready to be done, and gave back everything you saved. The markup on the loan erased the discount on the car. The negotiation was theater. The finance office was where the real money was made. And you were the least prepared person in the room. The Consumer Financial Protection Bureau investigated this practice. What they found was not just expensive, it was discriminatory. In a landmark enforcement action, the CFPB fined Ally Financial, one of the largest auto lenders in the country, $98 million after finding that minority borrowers were being charged significantly higher dealer markups than white borrowers with comparable credit profiles. The same credit, the same risk, a different rate, because the dealer had discretion, complete unchecked discretion, to decide how much to add on top. And that discretion, the data showed, was not applied equally. Ally was not the only one. The CFPB pursued multiple lenders. The pattern was consistent. When dealers are given unlimited room to mark up a rate, the markup falls harder on the people least likely to know it's happening. Not because of explicit intent, but because the system was built with no transparency and no accountability. And a system with no transparency will always produce unequal outcomes. That is not a theory. That is the data. And this is still legal, right now, today, in every state. No federal law requires the dealer to tell you the buy rate. No regulation caps how much the dealer can add. The disclosure you signed in that finance office listed the annual percentage rate you agreed to. It did not list the rate you qualified for. It did not list the spread. It did not mention that the person across the desk was earning a commission built into your interest rate, paid for by you, every month, for 5 years. Think about any other transaction in your life where the person helping you is secretly marking up the price and keeping the difference. Think about what you would call that in any other context. Now think about why it's permitted here, in one of the largest purchases most Americans will ever make. You were vulnerable from the moment you sat down in that office. Not because you're naive, because the room was designed to make you vulnerable. You had already committed emotionally. You'd spent hours at the dealership. You'd test-driven the car. You'd negotiated. You were mentally finished. The finance office knows this. It is the last room you sit in, deliberately, because by the time you get there, your resistance is gone. You just want to sign and leave. And that is exactly when the margin is applied. The dealer doesn't even need to lie. He just needs to not tell you. He shows you a rate. You don't know there's a lower one underneath it. You have no reference point, no comparison, no way to know, unless you walked in with one already. And that is the entire solution. One step. Before you go anywhere near a dealership, you get pre-approved for an auto loan. From your bank, from a credit union, from an online lender. You walk in already knowing what rate the market is willing to give you, because a lender already told you. Now, when the finance manager turns his screen and shows you 7%, you already know you qualified for 5 somewhere else. The markup becomes visible. The leverage shifts. The entire dynamic of that room changes because you are no longer the least informed person in it. Credit unions in particular tend to offer rates 0.5% to 2% lower than dealership financing. They are not marking up the rate. They are not earning a spread on your loan. They are lending to you at cost. That option has always existed. Most people don't use it because the dealership makes financing feel like part of the car buying process. Like it's one package, one flow. You buy the car, you finance the car, same place, same day, done. That convenience is the product. The markup is the price of that convenience. And you were never told there was a price. You negotiated the car. You fought for a fair deal. And then you walked into a room where the person across the desk had a number you couldn't see, added a margin you couldn't detect, built a profit into your interest rate you would pay for 5 years, and handed you a pen. The next time you buy a car, walk into that room already knowing your rate. That one number, the one you bring with you, is the difference between paying for the car and paying for the car plus the privilege of not knowing what you qualified for. Nobody in that room will show you the buy rate, but now you know it exists. And that is the one thing the finance office was never designed to survive.